Welcome back to another video. In this video, we are going to talk about the S&P 500. We're going to talk about the psychology behind the loan on the buy, borrow, die framework. And I can promise you, by the end of the video, you'll be in the top 1% of understanding of financial markets. The truth is, the wealth gap is a knowledge gap. So what we're going to talk about is how the top family offices in the world structure their wealth, and we're going to discuss the S&P 500. So we're going to shatter some illusions on the S&P 500 because it is the most discussed index in the financial community. For years now, everyone just talks about how it always recovers, you're guaranteed a 10% return, and everyone should invest in it and don't ask any questions. Well, we're going to ask some questions, and we're actually going to dig a bit deeper because I want to know the truth. The quote we're quoted is 10.4%. Yeah, that's what we are generally quoted for the annual return. So since it was incepted in 1957, 10.4%. So the financial planners, financial advisors, that's really what they're quoting. And is that the truth? Well, they use CPI inflation. They say it's 3%. So as long as you beat that, you're getting a 7% true yield. The problem is they have immediately used the wrong calculation. Therefore, the entire framework is wrong. And I'm going to prove it using various evidence to make it completely irrefutable. If we account for the money supply, which has grown annually around 6.74%, this means the true yield you're getting after we have accounted for money printing is 3.66%. This is because the money supply in 1959 was 286 billion and today it is 22 trillion. Anyone can verify this for themselves on the official Federal Reserve website. This is common public knowledge. Right there, that's where I got the numbers from. So it's right there. This is available to anyone and everyone that wants to have a look on the official source. And keep in mind, this doesn't actually include euro dollars, which are outside of the system. So it's actually, many people argue that it's actually higher. But based on what we have data on, that is the facts. Now, the most important objection you are going to get to this, if you come across an economist professor, someone who's well educated, they are going to use a specific argument to say that this is not true. So it's very important that I explain how we refute this. Because what I've noticed is I have a response from ChatGPT. Now listen, I think AI is a fantastic tool. I use it. It's incredible. We can do things much faster. It's going to progress the human race. But it's not always correct. It's not always correct. Because it's trained on the textbooks. It's trained on traditional education, who want to protect the actual reality of inflation. What you will hear is velocity. Well, all that money that gets printed gets soaked up by productivity. Therefore, it doesn't actually cause inflation as bad as people think. So we're going to refute this. I'm not going to sit and force you to read a full ChatGPT response. But all you need to know is it gave a very academic explanation to say, why I was wrong. However, the easiest way we refute this is this is the only part I would care for you to look at. We look at the M2 increased by 78 times. So the money supply grew by 78 and CPI prices increased by 11 times. So the missing 67%, it says it went into growth, turnover, and dollars held out of the US economy. This is where we're going to get it. CPI is the cost of survival. Milk, bread, eggs, and iPads. If you want to be rich in eggs, milk, and bread, track CPI. If you want to track the cost of power, you track M2. The cost of assets is M2. So there's ChatGPT giving us a response. And straight away, I want you to remember the missing 67%. Well, coincidentally, gold went up exactly 67%. That is the proof right there. So when a well-educated person explains this, you just simply ask them, well, why is gold went up 67%? And without even using this as evidence, we humans can just feel it. We can just feel it. We can just feel the cost of assets is higher. How much does a house cost now in in high demand areas? Does it feel like they've went up 3% a year? Absolutely not. Absolutely not. Look at during COVID, the money supply increased by 25%. Remember the housing bubble during COVID, 2022 to 2021. The market was going wild. Even just the price of cars were through the roof. Real estate through the roof. Total bubble. And the civilian mind thinks, oh, it's just supply and demand. They're like, why are people bidding 50% over the value of properties? They don't think, well, it's because the money supply has been increased by 25%. They just think, oh, it's just, supply and demand. But now we know. Okay, so this is so important because when you understand all this, it changes your entire framework on how you look at assets. Completely rewires the brain, and it takes away so much fear and anxiety surrounding this strategy. Another question legacy financial advisors use is they say, well, the S&P 500, it has a 100% recovery rate. This is true. This is absolutely true. But then you ask them, well, why? And they just say, well, companies continue to make more money. The economy always recovers. It just recovers. They don't actually know the reason. Let's look at money supply chart compared to the S&P 500 chart. What a coincidence. What a coincidence. They both have went up, just lines that go up to the right. Incredible. Okay, so incredible. Do you know the thing with the S&P 500 is it is so dominated by the top companies, the true monopolies. They are dictating the majority of the true growth. The actual earnings are dominated by Nvidia, Google, Apple, Meta, Microsoft. They make more money in a single quarter than, like, you can combine some of the biggest companies in the world, like Starbucks, McDonald's. Yeah, these huge companies. And one of the Mag 7 will generate more free cash flow than those companies could generate in 3-5 years. They are so profitable, and it's not even a fair fight. So you're really just invested in the best companies and being diluted by dead weight. Here's the strongest piece of evidence. Let's look at Argentina. Remember Argentina hyperinflated? Their stock market, it grew by over nearly 500,000%. Right? Look at this. This is so easy to verify. You can just type it in Google like I've just done. There you go. The total nominal growth from 1989 to 1991 was an astronomical 427,250%. Can you imagine everyone looking at their 401k and their index fund and watching it go up 500,000%? They would pop in champagne bottles. They'd be celebrating, saying, look, we're making so much money. I mean, surely at 500,000%, then people would start scratching their head and saying, well, wait a minute, is this currency actually real? I mean, does it mean anything? Does it actually mean anything? No, it doesn't. It's printed paper. It's not real wealth. Cash is just a melting ice cube. Now, I don't believe this will happen to like the USA anytime soon anyway. But it's just so slow and gradual that it's just happening little by little that people don't notice. People do not notice. So therefore, it's almost like when you see this, you start to think the stock market is almost like a pacifier. It kind of works like a pacifier because money can get printed and it goes into the assets, and everyone looks at their index fund and feels wealthy. Now, there is some years, like this year actually, where the S&P 500 does outperform M2. So does that mean the strategy's gone? The strategy's wrong? Absolutely not. There will be years during productivity booms where M2 can grow at 7%, the market rallies at 30%, but it actually can often mean the market is overvalued. That's the other side of the problem. So if it's vastly outperforming, it means there's a lot of leverage getting used to buy assets and it's growing into bubble territory. So let's discuss the biggest psychological hold as well on the the debt. This is a big problem for people. A big problem for people because humans have been trained that debt is like a predator. Debt is dangerous. Yes, if you've got a credit card with like 30% APR, that is dangerous. If you're taking car finance out on a depreciating asset, paying 20% or 10% APR on a dying asset, of course that is not good debt. Good debt is where someone holds the most productive assets in the world, like Microsoft, Google, yeah? These massive Mag 7 companies. If you're borrowing against these strong companies, that is not bad debt. It's actually it's the complete opposite. Look at this example I've created. If someone invested, say, 100 grand into Google and held it for 10 years, and assuming Google grows at 20%, what actually happens then, right? So when someone takes out a 20% margin loan, so people are in fear of this debt they've got, and they always ask the question, well, I don't know how to repay it. How do we repay it? What actually happens with the broker, they do not ask you for a monthly payment. I don't know if there's some confusion on this, but there's not like a car payment. You don't need to pay it. They just add a small amount of interest on top of the loan. It's capitalised. It's interest only, and the interest doesn't even need to be serviced. It just gets added on because the broker has virtually no risk because they have the collateral. The collateral is your Google stock. If it grew over 10 years, 20%, Google becomes 620,000, yeah? And the loan grows as well. So there you go. The loan grows, but Google grows faster. This is it. It's not about repaying the debt. It's about assets that just grow faster. It's a race. It's a race. That's really it, because what assets can outrun this money printing? If you're not outrunning the printer, you're going to get left behind. And yes, the S&P 500 will at least match it. It's better than the alternative. But if you truly want to use a strategy, We can't borrow money at 5% with a 3.66 true yield. And we do not hope the S&P 500 outperforms the M2, because hope is not a strategy. We don't rely on the Federal Reserve behaving and the commercial banks behaving. Well, there is a sovereign debt crisis of $40 trillion, which is not going away. So you have to face it. You have to come up with a strategy, because there is no government. I don't care who you vote for. It doesn't matter. They can't change $40 trillion of debt. There is only one answer, and it is to inflate the debt away. How do you inflate the debt away? You print more. That's it. You just print more money, and the dollar gets weaker and weaker and weaker. Now, the people that don't understand the strategy we're talking about in this channel will be left behind, unfortunately. Because when people are, the common communities are not able to fund their lifestyle, they feel like they've got a squeeze, the cost of living is crushing them. They don't understand the fact that it's because they're fighting for cash. They're chasing after cash, which just melts. And it's a race they can never win. You cannot outwork a sovereign debt crisis. You have to structure an architecture that does it for you. Now, the other part is we actually benefit from the money printing, because our debt gets less and less in real value and our assets go up. Okay, so what's happened here is the loan to value was 20% at the start, and now it's 5.7%. Okay, so there's a chart just to explain. So red is the debt and the green is the equity. So there you go. Your Google stock has grown and the debt's shrunk. Your net worth has increased every year. So if your net worth is increasing, why would we clip the wings of Google? So we punish Google for its success by selling it to pay off negligible debt. Family offices do not do this. They look at this debt as a tool to fund lifestyle. Another common objection is people say to me, well, Warren Buffett sells stock. So you're telling me not to sell stock, but Warren Buffett does it. Yes, Warren Buffett sells stock for another potentially better investment, or to plug it into T-bills, which is on top of his $400 billion cash bill. You can't compare the strategy of Warren Buffett to the strategy of a civilian. A civilian sells stock to buy cars, watches, clothes, milk, bread, eggs, and iPads. Why would we sell a productive asset to buy a liability when we can use a melting ice cube of debt, of cheap debt, to fund those purchases? Our loan to value is shrinking. Our assets are growing. The actual debt is also decaying as well. It's decaying at -2%, depending on the interest rate of the loan. So the loan is interest rate could be 5%. That's important as well. If you're on your platform must be an institutional brokerage where they offer you institutional rates of 5% minimum. It will track the federal base rate by maybe 1% or 1.5%. The more you borrow, the cheaper the debt. So the debt's actually losing its own purchasing power. The actual value of the debt by year 10 is actually only 16,000. Everyone knows that the 20 grand from 10 years ago can't buy the same stuff as today. Well, the same applies to debt. The same applies to debt. You see? When you see people talk about the fear of the debt, it's because they don't understand we're playing a different game entirely. We're playing a different game. And the sad truth is as well, many people, you see all the time on social media, people talking about, if you invested this much in this stock, you would have this much in 10 years. Almost nobody does it. Almost no one does it because most people sell. Most people sell their stocks. And some of the best investors, one of the biggest mistakes they make is selling the stock too early. Peter Lynch talks about this. Even Warren Buffett admitted he sold positions too soon. So everyone's a victim of it. Because there's actually, and it's almost like when a stock crashes, the same fear that a person has about selling a stock that's crashed is the same fear to someone whose stock goes up 20, 30, 40%. They think, if I don't sell now, what if the stock goes down and I lose all that money that I could have sold it for? It's the same psychological game that's getting played, just on the opposite scale. And this is why, for a start, to take away that whole fear anyway, we only invest in the absolute biggest, strongest monopolies that are generating huge free cash flow. Because if you're investing in a low cap stock that's price to earnings has expanded beyond reality, then yeah, you probably should have the fear of wanting to sell it to lock in the money, because you're just trading. You became a trader. You're not an architect who's structuring a family office position, which is what we're playing on this channel. So there you go. This is more psychology on the debt, the reality of the S&P 500. So just to remind you, look, nominal growth, 10%, currency debasement. So there you go. This is why I say I don't want to borrow against it, because you're effectively hoping the S&P 500 outperforms M2 every single year. And it just doesn't. Historically, it doesn't. So we take a loan out, but that's our true yield. It's not going to work. The only other index I have identified is obviously the NASDAQ. The NASDAQ returns about 15%. Or, I mean, last year was obviously 40%. But it's more likely that the NASDAQ will outperform, because we have got the growth stocks. We have the growth. So it's totally different. Yeah, so there you go. This is the strategy. And as far as the actual portfolio, I've got other videos you can watch on a buy, borrow, die portfolio. We use the barbell strategy. We need strong growth and strong defense to make the strategy work. And we do not over leverage, and we are operating under strict rules. So there you go.